I think one thing that continues to be relevant and has morphed over time is we need to be looking at the world through different lenses, especially when we are thinking about things like our finances in the context of the world. There might be things going on in the world that we don't like, but if we're really willing to sort of separate our feelings and thoughts and whatever, we can see a path for things that do tangibly matter for the investments in our portfolio.
Welcome back to The Long-Term Investor. Today, I have returning guest Sam Rowe, author of the awesome Substack, TKR. Sam, thanks so much for joining me here today.
Thanks for having me.
I read your stuff every week. Maybe just start there. Tell the audience about your Substack, the type of stuff you're writing, and what your subscribers get when they join your newsletter.
Ticker is news, data, charts, insights for the long-term investor. I guess we probably have a lot of overlap in terms of our target audience. The story is I come from the news business where every day we have to try to explain why the market's moving in that particular day and all the forces and factors, whether it's fundamentals or technicals, that might explain that. But I've always gotten a lot of feedback from people saying, I don't know if this framing is particularly helpful. I read the news every day, but I don't know what this means for me in the context of, my 401k plan, or in the context of the fact that I'm invested for the next 10 or 15 years. Should I be scaling back, taking risk back? Should I be reallocating, et cetera, et cetera? So I write about all the same news and data and the market events that happen, but with with the long-term investor audience in mind. So it's got to be, yes, there are these geopolitical events that might be moving markets today, but I will also make sure to include information that helps us understand what that means in a longer term context. Um, you know, Stuff like a hot research note is circulating on Wall Street, and everyone's talking about what the market might do in the next year. And I'll make sure to balance that out with sort of the historical context of what that all means and the odds of a strategist nailing a price target, and again, how we should be thinking about this in the context of 5, 10, 15-year longer term time horizons. So there's not a lot of stuff that's particularly unique, unfortunately, in terms of news or data. It's just that it's framed in a way for people who do think long term, and it seems like there's an audience for stories that are framed that way.
Well, it's certainly what draws me to your work. And what's funny, as you explain what your Substack is, I think we had the same conversation last time. I always call it TKer, so that for those listening or watching, TKER.com. That's how you find Sam's stuff. And you're calling it Ticker. So I think this is the second time now in a 12-month period where you've corrected me. And I'm probably telling everybody the wrong name, but at least everybody can spell it now. And we're recording on March 3rd. To be honest, Sam, I don't know when this is publishing exactly, but the big news story today is what's going on between US and Iran. Last week, it was AI-induced fear, particularly around a research piece from Citrini. One of the things that's interesting, though, is let's say we do publish this episode a month from now. It might be a totally different story that has everyone's attention. With that in mind, tell me a little bit about kind of, as you're reading the news, what are some thoughts and questions in your mind? What are things that you have people asking you? And what are some of the things that you are planning to write about?
I was thinking, especially with Iran, I was wondering about how I might approach writing about this for my audience. And one of the first things I often do is go back to see what I've already written that might help me, back into some research that might be helpful for in today's context. And the last time I wrote about geopolitics and risk events and the threat of, the Strait of Hormuz being disrupted and oil prices rising was a little less than a year ago, and when we did have tensions escalating in Iran after um, some targeted attacks from from the U.S. And so a lot of what we're talking about in the current episode is very. It's not the same. Nothing's ever the same, but it's very similar to what we faced yesterday or last year. So with that in mind, I try to think about, well, okay, let's, instead of just sort of thinking about these generic ideas of geopolitical tensions rising and uncertainty rising, well, how can we make connections back to what's happening to what's going on into financial markets and things that might be affecting our portfolio? Um, a few things come to mind. One, there's not a whole lot of commerce happening directly between the U.S. economy and the U.S. publicly traded businesses with the economies in that region. There is some businesses are more exposed than others, but if you are somewhat diversified in your portfolios, the exposure is somewhat small, and it's small enough that you probably are dealing with geopolitical risk on a rolling basis. But there is this question about things like energy prices and specifically oil prices. What's interesting there is how the implications of higher or spiking oil prices, how that has evolved over time. I think there are three things that are worth noting, and they're sort of interrelated. One, the U.S. has become a net exporter of oil. So when oil prices do rise, there are some offsetting factors from a macro perspective. There are businesses in the U.S. that might actually benefit from higher oil prices. They suddenly see their margins go up. Suddenly, the economics of drilling in certain shale basins might improve, and so there is kind of an offset there. From the consumption standpoint, nobody likes to see gas prices rise. Nobody likes to see their energy bill rise. And yeah, that will be a headwind for consumers in the context of personal spending. However, the everything we do is a little bit less energy intensive because thanks to uh, perpetual improvements in how things are uh, uh, improving from a technological standpoint and a fuel efficiency and energy efficiency standpoint, it takes less energy to do the same things that we were doing, years ago. So stuff like the fuel economy for cars, just hit, a new record high. Like this is information that's available on the EIA, but we don't need to look up the EIA. Anyone who's driven a car for more than a couple of years knows that you're getting more mileage out of a gallon of gas than you did with your previous car or the used car that your parents handed down to you. That's one thing. And in a more macro sense, um, spending tied to energy consumption, whether it's electric bills and gasoline or whatever, that spending as a percentage of personal consumption expenditures has been on a very long secular, structural, whatever you want to call it, decline since basically the late 70s and the early 80s. So, $100 or, a 20% spike in oil prices today has far less of an impact than a 20% spike in oil prices 10 years ago or 20 years ago or 30 years ago. Not that we're going to get a 20% spike in oil prices, but it's just, you know, we as both an economy and a stock market and a consumer have just been less and less exposed to things like oil. And so again, every geopolitical event is different, and we'll pay attention to things like escalation. But for the time being, history tells us that um, the our exposure, it has been shrinking, and even when exposure was higher, the markets tend to eventually look past these events.
And so what's crazy to me, though, Sam, is if you open up the Wall Street Journal's homepage in really big letters, this is the headline. you might notice that markets are down. And if you don't follow markets a lot, you wonder, well, I remember there was a sell off last week. Are markets like in a downturn? And in reality, they're really not. And if you look, as you were talking, I pulled up a number from Vanguard that if you look at the going back to 1962, just looking at geopolitical events, the average total return 6 months after an event is 5%. And then if you look 1 year out, it's 8%, total return after a geopolitical sell off. And I guess if we had to make a headline that we weren't going to be ashamed of a year from now, if we were to look back on this, maybe it's something like, hey, people feeling a little jittery today, but at the end of the day, the long-term driver is going to be earnings. And a lot of times what I will tell clients, volatility, very normal. It's always the narrative, not the actual volatility that I think gets people nervous. And so I have them ask themselves, well, how do you see this impacting earnings? And what I really appreciate about your approach is here you've kind of had a very thoughtful analysis of the energy impact of what's all going on. But if I had to guess, you were going to say what's going to be the biggest driver of returns the next 12 months, I assume you'd say it's earnings. Is that right?
Absolutely. And I think this speaks to something I've written about, quite a couple of times, and this is sort of like a popular way of thinking that I think has resonated with my subscribers, and it gets shared a lot. Is this idea that we sort of have to separate how we think about the world. Maybe from a policy standpoint, you can feel certain ways, and you have certain views about how the administration is implementing policy for social reasons or whatever. There is another way of viewing the world from the lens of the economy. Kind of like how we were talking about before, in terms of our exposures when it comes to things like higher energy prices might be bad, lower energy prices might be good. But from the investor perspective, the only perspective that actually matters is what's going to what's going to have an effect on the various assets in my portfolio. And like you're saying, at the end of the day, really, if there's any source of gravity when it comes to asset prices, especially stock prices, it's going to be earnings. Over time, it's going to be earnings. And if we're going to get volatility because of market volatility because of geopolitical events, or uh, uh, some reports that might have people concerned about the near future and all these things. Um, yes, we do want to check in on earnings, and fortunately, every company out there is giving us a very tangible, quantifiable update every 3 months. But assuming there's not a whole lot of change in terms of those prospects for earnings and earnings growth, the market volatility is just a reflection of risk premiums going up and down. So if the market's selling off today because of some geopolitical event, then maybe it's just the market just applying a bigger discount to the earnings that we're paying for, which would actually explain why returns tend to be stronger in the months following something like a geopolitical event, because you have volatility, because uncertainty you know gets priced in the form of a discount. Then the upside is by definition is going to improve, assuming the earnings prospects are intact.
And I think what we're talking about is just so fundamental and yet gets so lost among market watchers or investing enthusiasts in the first place. Over the long term, prices tend to go up as profits increase. They tend to go down as profits decrease. But then they also move just based on expectations of the future. I'd mentioned at the opening, hey, last week, people started questioning their viewpoint of the future when there was a just kind of a scenario analysis, like a tail risk event scenario analysis that came out about AI, where, yeah, the economy grows, but less people have jobs as a result, and then people can't pay their mortgages. And then that just like continues to tailspin in a really negative direction. What I think is always important for people to remember, JP Morgan does a great job putting out a chart like this where it shows, hey, what drove return last year or the year before that or years before that? And you can see it's change in earnings, the cash paid to shareholders, whether that's dividends or buybacks, and then changes in valuations. And so that valuations is almost like a psychology measure of sorts. Today in the US, valuations are high because things have been going pretty good. On the other hand, just because valuations are high doesn't mean for sure that you're going to have bad returns in the next year. There's some evidence that over 10-year periods, it's a little bit predictive, if not perfectly so. But when you look at today's earnings landscape and valuations, what are kind of just some of your high level thoughts on markets in general?
We could probably talk about this for, 6 or 7 more hours.
I'll call my wife and tell her, don't wait up. Here we go. Everybody strap in.
A couple of things. Fortunately, uh, you don't have to really torture the data to get what seems like a reasonable explanation as to what's going on from the perspective of things like valuations. One thing that we have very clear evidence of is uh, profit margins, both net profit margins and operating profit margins for the publicly traded companies of the stock market. In particular the S&P 500, which accounts for like 80% of U.S. publicly traded equities, have been on a structural rise for a couple of decades now, and uh, it's a little wonky, but all things being equal, when profit margins are going up, your return on equity, what you uh, should be getting on the money you invest in stocks improves. And so when you do have a better return on equity, then it makes sense that valuations are higher. And if you want to put it in plain English, another way to put it is if you have structurally higher profit margins, you can also just say, well, companies are just operating better. Companies are making more money with what they have. And when companies are better by any measure, you would think that you want to pay a premium for the earnings generated by that company. So yes, there's a lot to say about this historical relationship between things like PE multiples and forward returns in the market. Unfortunately, and while there is some it's such uh, a clean measure when you do chart that out. Elevated PE ratios and then long-term 10-year returns gives you a very compelling dot plot, which basically tells you that there's very history says there's a very high likelihood of relatively low returns. Unfortunately, it's just the oversimplification of what's going on in the world. How can you determine what's going to happen in the future in terms of financial market returns based off of one variable that's backwards looking? And if anything, something that we've learned in recent years, and listen, I'm not saying that we should see high double-digit earnings growth into perpetuity. I'm not saying that won't happen. I have no predictive power there. But what we do know is, at least in the last couple of years, we have had incredible earnings growth, and that has been accompanied by elevated profit margins all along the way. And all of that seems to explain pretty well what has happened in the stock market. And I'm just remembering, and I wrote about this recently regarding valuations. Um, you know, uh, it happens to be the case that you, Peter, had actually written a piece about 10, maybe 11 years ago. I remember this. I remember this, Peter. This was and it was a crazy time. 2015 was a crazy time because that was when we first heard that the cyclically adjusted price earnings ratio, made famous by people like Robert Shiller, that measure had finally returned to a level that was last seen during the global financial crisis. A sentence and a headline that would freak everybody out. But as you mentioned in your piece, there is actually quite a range of outcomes. When it comes to the forward returns at a certain level, but importantly, what the history doesn't show, um, that 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 wasn't couldn't have been predicted about what would happen from 2015 to present day is that we had incredible earnings growth. And, that helps explain why we have a market where we are today.
That's such a great example of why the internet is the best thing ever. Because here I am reading Sam's newsletter on a weekend, and I see him linking to something that I wrote so long ago. I think, oh my gosh, is that still out on the internet? Um, as we, and I even just now was Googling it to be like, wait, when was that? And yeah, it was about 10 years ago. And I think a lot of what you're talking about with valuation obviously resonates with me. I mean, you can use it to set expectations, but if you invest according to it, there's a good chance you're going to get burned. No perfect predictor in the near term, but say like that PE ratios are high, and what are we defining as high? Well, if it's historical averages, one thing that always comes to mind is, well, if I'm going to pay, like, how many dollars am I willing to pay for a dollar of earnings? Like, am I willing to pay $15 for $1 of S&P 500 earnings? Well, I might be willing to pay more today than I was back when there was no accounting values whatsoever, or when like the Fair Disclosure Act didn't exist, or there, you mentioned just the fact that companies are run better, but information is a lot more trustworthy. And so that valuations should be above long-term averages, just kind of as their base rate, to me makes a lot of sense. But yeah, I also recognize, like, back then when I was writing the piece, and I can find one mention of it in 2015 and one in 2017, I'm looking at kind of the takeaway and I'm saying, hey, like, if I had to make a bet over the next 10 years, it's more likely that these are going to trail its long-term averages. But in the range of outcomes, they sometimes beat it. And sure enough, in the range of outcomes, we got better profit margins. We got a lot more earnings growth than we would have ever expected 10 years ago.
That's a reminder that there are no sure things in financial markets. Even the expectation, how we, and I hate to say it, but even the way we set up our long-term investment strategies, there's no guarantee that we end up in a place where we are even within, a comfortable margin of error of what, we're hoping for. And so, but we do our best to keep an eye on what we understand to be the fundamental drivers of prices and things like that. But yeah, but getting back to your point, I think um, one of the biggest mistakes an investor can make is to have, too much confidence in what is not a perfect metric or a perfect indicator of future returns or whatever, which is actually just the case for everything. If you had such a high degree of confidence that, again, like, this is backwards looking information, that we were going to underperform for the next decade, um, you know, it's very unfortunate. Like, hopefully you found some other way to, make up for that underperformance in some other asset class that, hopefully did well. Um, but yeah, it's tricky. I mean, here's another way to think about valuation ratios that might be 17 on a long-term average, but it's at 22 or 23, which feels high, or is it 14, a great buying opportunity. Um, I mean, listen, I'm actually using some very crude math here to say this next thing, but I know Yuri and Timur at Fidelity has done some of this analysis, and Goldman Sachs often publishes this in reports that are freely available on their website. But they will do like just a straight relationship, a regression of things like S&P 500 12-month earnings, going back 100 years, and prices going back 100 years. Now, again, we're sort of uh, falling into this trap of, well, how much can we rely on long-term history? But bear with me for just a second. When you track earnings over time and overlay that and do a linear regression with prices over time, yeah, that's one of the tightest correlations you're going to get in anything that's observable in the universe, is that earnings and prices track each other very well. Now, when you do zoom in with a microscope, you do see that earnings has noise along the way and prices has noise along the way. Those fluctuations in this what looks like a very smooth line, two smooth lines, those fluctuations is the PE ratio. By definition, it's the PE ratio widening and contracting. When the PE ratio might go a standard deviation above its long-term average, that's still within a reasonable margin of error where things might actually just still turn out right. Again, gravity, the real a PE ratio is not gravity. Gravity is earnings, right? And so if we really want to be concerned about the future, you have to really, let's get back to the basics here. I need a case for why earnings are going to fall apart. I don't need a case for why PE ratios might contract from 22 to 18. I mean, give me a break. It's like if we're talking about like 100 PE ratio, that's completely different. And again, this is also kind of intuitive when you think about it. If you are starting a business tomorrow and it's financed in a certain kind of way, and your plan is to try to earn back your investment in 18 years with a PE ratio, but it turns out that you get to year 18, but you have to wait 4 more years, and it turns out it takes 22 years to earn that money back. Hey, that's not bad. Most businesses don't turn out that well. So yes, again, that said, an extended valuation ratios is certainly a thing that you use to manage expectations. But again, at the same time, history also tells us that you might actually still get a healthy return even when valuations are elevated.
I really like that example. And allow me to wander around a little bit as I know what I'm going to ask you, but it's going to take me a little bit of a path to get there. So, we're talking about expectations and such, and the imperfection of using valuation as what might happen over the next 1 year or 10 years. And I actually did an episode on capital market assumptions a little while back. I'm scrolling episode 240. So if you're watching us on YouTube or on Cheddar, you can go to longterminvestor.com. You can go to episode 240 and kind of see why different ways in which people set return assumptions can really impact your financial plan. And I'm just not a huge fan of somebody who's going to have a larger weight towards what they think is going to happen over the next 10 years, in part because of some of these outcomes. Now, one thing that has happened in the past couple of years that I think is kind of interesting is, throughout the past 10, I guess we've been saying, look, international valuations are a lot lower than US valuations. And as a result, we would expect international to eventually win. The win, is that going to happen? We've never been sure. They certainly won in 2025. They're certainly looking good now. Will it continue? But what's interesting is when you look, kind of going back to what we were talking about earlier, where returns are driven by changes in earnings, the cash return to shareholders, and the changes of valuation. And if you look at how did the US just crush international over the past decade plus, a lot of it was that they were outgrowing on fundamentals. But the past 2, 3, 4 years has been that they've been outgrowing on price multiples relative to those fundamentals. So it is possible to continue to win on having better fundamentals. The other way, winning because simply people are willing to pay more for the same fundamentals, that's not something that's super sustainable. And I think that's a lot of what we have seen more recently in US finally underperforming non-US stocks. I know you've written not terribly long ago on this topic. When you look at those sorts of returns in the go forward, what are some of your thoughts in that space?
There's so much to unpack when it comes to thinking about US stocks versus international stocks, and how you want to be allocated, and for what reasons. And that's really important. Um, you know, the first quick thing I'll say, and I think this has been repeated 1,000 times, but it bears repeating, is that when you do invest in non-US stocks, it's not as simple as trying to get exposure to non-US companies. Something between 30 and 40% of revenues generated by S&P 500 companies are generated abroad. And it is actually the case that for a lot of companies in a lot of these non-US markets, in places like the UK and Japan and Germany, when you buy stocks in those countries, a greater share of revenue is coming outside of their economies. So, you might not be you might not be getting the kind of geographical economic diversification that you think you might be getting. But of course, any financial professional or advisor is going to be able to answer that question. But for people who don't understand this, if it's just about geographic exposure, something like U.S. companies and the S&P 500 do a sufficient job of taking care of that. And so it really has to be about something else. It has to be about how companies operate in the U.S. versus how companies operate in the non-U.S. Regions that you are thinking of diversifying into. And there are all kinds of things um, that I guess you can quote unquote get diversification from, and it's not just regions. Um, the way they think about stuff like executive compensation is very different around the world, and therefore companies will just be managed differently because of incentive structures in terms of how those companies operate. Local regulations in terms of how much and how hard you can work your workforce and what kind of benefits that you have to provide. Taxation affects how a company operates in various countries. The fact that for better or worse, most people might tell you worse, that so much of how we have to plan our retirement in the US is tied to the performance of things like stocks in our 401k plan, which, sometimes gets you exposure to companies at which you work, might incentivize you to, perform a certain kind of way at the company in which you work. Not to mention the fact that because of how tight things feel when it comes, because it is your own responsibility to plan your own retirement, then you might actually be working a whole lot harder and for a lot longer than you might expect. So all that is to say that when you do diversify internationally, it's less about just regional economies, but it is things like incentive structures and how companies operate. Now, if you do, I think Deutsche Bank does a nice report on this, comparing fundamentals in different regions. One thing you notice, and we spoke about this just a couple seconds ago, whether when you compare companies in the U.S. markets versus European markets versus the Asian markets and Middle East and Africa. To no one's surprise, the companies with the highest profit margins are in the U.S. And this is something that lags. And some of it has to do with different industries in some of these different economies. But that begins to help you understand why some of these places trade at a discount relative to the U.S. Or maybe it's the U.S. trading at a premium. As to what's been going on the last couple of years, where those narratives are have been sort of reversed with non-U.S. markets outperforming. Well, getting back to what we were talking about, maybe we're actually seeing some major structural changes or potential for structural changes happening in some of these non-U.S. markets. We've just been talking about stuff like protectionism for the last year and closing borders and altering trade relationships and all this stuff. Maybe there are things happening in non-U.S. economies where the incentives are starting to point in a direction where it matters that your local companies have to actually be, national champions that, perform well. And, maybe there will be reforms and some countries are, if they haven't already, are talking about reforms that incentivize things like, let's actually focus on shareholder returns and not just, alternative ways to provide social safety nets for the people in our country. So I'm not, that said, I'm not super sophisticated and totally read up on what's going on in the rest of the world, but every time I do pick up the paper, you have people like Mario Draghi out there urging, some reforms both from a regulatory or cultural perspective that would explain why we might start thinking about paying a premium for stocks in some of these non-U.S. markets.
I love the point that most of these stocks outside the US don't generate revenue inside their own country. And I have conversations with allocators from a number of countries throughout the globe, like Australia, Japan, Singapore, the UK. And something that still just kind of messes with my head, and I haven't really come to some worldview on it, is that they all have a home bias in their portfolio where they invest primarily in their home market. And I think that's useful for investors to understand is you might think, well, why wouldn't they invest all their money in the US? Like, clearly this is the best market. Like, why wouldn't they do that? And so, like, you're spending dollars, so you invest more in dollars. When you go outside the US, you get some currency diversification. But Sam, I have had to defend international diversification for, more than half of my career. When I started my career, nobody wanted anything to do with US stocks. They just wanted emerging market stocks. That we might see the tides turn is exciting for me, except then I know that people just want more international and less US. But let me tell you, when people have always said, like, why do you invest in international, especially when the data set, like the international data set goes back to 1970 or like the most robust one. If I were to look, though, at like periods in where the S&P 500 underperformed cash, there are 3 periods in the S&P 500's lifetime that are more than a decade where they lost to cash. There's a 15-year period that started in 1929. There's a 17-year period that started in 1966. And then there's a 12-year period in 2000. All of those periods, cash beat the S&P 500. So if you're an investor who wants to be all US, you just got to remember there are going to be these long extended periods where that decision doesn't work out for you. And if you're willing to hold through it, that's fine. But if you're just going to bail and chase on whatever's performing better, it's probably better to have some kind of international mix, even if we don't know where markets are headed next. Because we don't know where markets are headed next, let me finish up on this question, Sam. You recently published your 9 most popular posts since you started the Substack. If you had to predict, I can see some themes within here on what's most popular and resonating with long-term investors. But if you had to predict the next thing you'll write or the topics that you'll write on that will continue to persist and be popular, what are those things that you find people are drawn to?
I think one thing that has continues to be relevant and has morphed over time, and we kind of touched on this a little earlier in our discussion, is the fact that we need to be looking at the world through different lenses, especially when we are thinking about things like our finances in the context of the world. There might be things going on in the world that we don't like, but if if we're really willing to sort of, separate our feelings and thoughts and whatever, we can see a path for things like, earnings growth and things that do tangibly matter for the investments in our portfolio. So yes, this whole idea that um, you know there's one view of the world where you think about it in terms of financial market assets, things like stocks and the fundamental drivers of that, and then it's not totally mutually exclusive, but there's another lens where you look at the world through the economy. Things like unemployment and manufacturing and GDP and trade and things. And while they are related to what's going on in the stock market, for instance, it's not a one-to-one relationship. You can have a world where the metrics that make up things like GDP or employment might go in different directions, or maybe not at the same rate as what's driving earnings in the stock market, for instance. And that's only really, and we're only talking about sort of those tangible, hard data measures of the economy. Things where, a transaction happens, that number is registered, and, the census or the Bureau of Labor Statistics reports it back to us. Do you have a job or do you not have a job? That survey measure is tangible, and the Bureau of Labor Statistics gives us a quantifiable update every month. And this is all a reflection of what consumers and businesses are actually doing. Now, there's this whole other crazy category called soft data, right? How we feel or how we perceive the economy. I think things are terrible. A lot of people will tell you that things have never been worse. And this comes up in things like the conference board surveys and the University of Michigan surveys, and some subcomponents of things like NFIB, small business surveys, and stuff like this. And that tells us something. You know, it's not great that sentiment's like. I mean, there's even philosophical question of, well, who cares if my portfolio is up? I'm unhappy. Well, all right, that's a whole other discussion. But again, I write for people with money in the stock market, and while I appreciate people being unhappy for any number of reasons, or people perceiving that prices are doing one thing, but corporations come back every 3 months and tell us, that's actually not what's happening. Um, I'm happy to talk about all those things, but in the context of me making decisions, I have to see what's happening when it comes to earnings and the prospects for earnings. And then like in the post that I mentioned, I actually talk about the four hats, right? There's the stock market hat, which I started with. Hard data, which is the actual measurable economic data that reflects behavior. Soft data, which is our perceptions and sentiment. And then there's this fourth category, which is this sort of conflicted, biased view of the market, where no matter what happens, you can massage it and reframe it in a way that either advances your own agenda or reflects positively on your political beliefs, or you're trying to confirm some other bias, or whatever, which unfortunately is something that we hear and watch on TV every day. Some people will tell you that the economy is doing great. Other people will tell you that the economies is doing terribly. It might be the case that both of them are wrong, because it helps them and their political constituents to understand things in a certain kind of way. But yeah, getting back to it, I find myself having to write about this either directly or indirectly quite frequently, because again, and this is also sort of one of the challenges of financial news. There's a lot of information that can be presented factually, but another thing I read about recently is this confusing idea that it's possible for things to be getting worse but still good, right? Um, that there are more than a couple ways to frame a story. I think Kevin Gordon at Charles Schwab actually just wrote about this in Schwab's blog, about how labor market, job creation, the there's this conflict between the stock versus flow story. The stock being net payroll, net employment based off of payrolls has continued to trend higher and has been ticking positively, and currently sits at a new record high. This is a very positive, bullish story about the economy. But from a flow perspective, it seems very different, because the rate at which U.S. employers have been creating jobs month in and month out has been declining for years. This looks like an awful story, but it turns out they're actually telling the same story. Job creation has been positive, which sounds great. The rate of creation has been tumbling, which sounds terrible. Now, again, you can spin all that, however you want to fit your own narrative, but the facts end up becoming the facts there. And, it's a fun discussion to have, and people like reading about it because now they have some extra insight that they can take to cocktail hour and happy hour and like correct people. Hey, I know that headline said the jobs report was great, but let's remember that the pace of creation has slowed. Or you can flip it on its side.
Never in my career has economic data spoken less to each individual than it does today. Just you can tell whatever story you want. I'm glad you bring up that point, because it kind of allows me to circle all the way back to the beginning of the conversation, where earnings is what's going to drive profits, and things can be bad in the economy. Things can impact you in real life. But if you're listening to this podcast because you're worried about how to invest your money, or if you're reading Sam's Substack because you want to know on how you should think about your own investments and the long-term trajectory, it's all about earnings in the end. And you got to recognize that biased hat that Sam mentioned, that's the one that the media is often using. They're going to use some combination of the soft hat, the hard hat, the market hat, and spin it with some bias that you freak out a little, or at a minimum click. So Sam, I appreciate you sharing your perspectives with us. Again, you can find Sam's work at his Substack, ticker, TKER.com. Sam, you're also publishing on social media. Where are the handles if people want to find you?
On X, at Sam Rowe. And I'm also on LinkedIn. You can just look up my name. I'm on there too. And yes, in the same vein that some people pronounce it ticker or TKR, it is also, I also have the added challenge in that it's a .co.
Oh, it's .co. I'm butchering this. There's no amount of editing where I can fix that. So everybody.
Fortunately, ticker is weird enough that you pop it into Google, you'll see the correct links that you need to get to. But yeah, I'm on social and I'm on Substack, and if any of the listeners are interested in seeing what's behind the paywall, just shoot me a note on any of those platforms and say, hey, I listened to you on Peter's podcast, and I'm happy to grant you a couple of compliments.
It's worth it, everybody. Don't let that offer go to bed untaken up. So Sam, again, thank you so much for joining me. To everyone watching, you can find show notes, links to the resources that we mentioned in today's episode at thelongterminvestor.com. Again, thanks for watching. We'll see you all soon.